Yo, what is going on, ladies and gentlemen? I'm not a financial advisor. This is not financial advice. If you want to watch me live trade in Discord every single day in the New York AM session, sometimes the PM, then click the WAP link in the description below. Really nice community of a lot of experienced traders, and it's just me and some guy named Leopard. So just the two of us running it. So there's not gonna be any confusions or anything. And yeah, pretty legit. So just click that link. Other thing is, if you want to get a futures account, there's an Apex 90% off sale. I did cop myself a few accounts just to backtest some mechanical strategies that I'm working on the side. My one's going well, so I mean, if it does well and passes, I'm going to share a new mechanical strategy that's not the inversion strategy, which should be interesting. So, cop yourself a few accounts. Just click the Apex link in the description below, and then use my code. So yeah. All right, so this has been a long-awaited video. I've wanted to make this for a long time, but this is gonna be regarding the thread I just posted, and it has to do with data lows and data highs. Okay, what is by data high? It's literally just saying data high. Okay, this is what I'm saying: data high or data low. Okay, now what is a data high or data low? All it is it's a low or high we get on an 8:30 news candle. It could be a 10 o'clock news candle. It could be a FOMC news candle. And the thing that they all have in common is you want to see either one of the wicks have like a normal size. So if we look at this one, this is going to be the only example I'm going to go over this video. These setups are very rare. They probably form once every 2 weeks, okay, but it is very accurate. Now, what I look for is I look for a normal size wick. That's the first thing, and I make sure that wick is on the 1 minute. It is also a swing low. Okay, so by a swing low, it has to be a low, and then here's a lower low, and then here's a higher low. So it has to be a swing low. Okay, and you really want it to be like an abnormal size. You don't want it to be a wick like this. Okay, this doesn't really mean anything. It has to be like this. Okay, and a lot of times what the market does, which I've told a lot of people this is maybe the reasoning, but usually when this data comes out, there's not a lot of orders that get filled down here. So that's why we end up going back, and it's a really nice liquidity pool. Whether that's true or not, I'm not entirely sure. I just know from back testing that we come back down to these a lot. Okay. So this is what I look for. It has to be an abnormal size wick. So this is what a data low or data high is called. Now, if you can see, okay, we did form a data high here, except it wasn't really anything abnormal. It was pretty regular size, I would say. This one's a little abnormal, and this one was already taken out. So when you want to trade data highs and data lows, you want to see the abnormal wick. You want to see that traded away from. So you do not want to see that hit. You want to see us totally just go the opposite way. And you can see we do. And when we go that opposite way, you want to see a bullish PD array form. So in this example, you want to see us go up, and you want to see us form fair value gaps. You want to see us form order blocks, because that's going to give you the opportunity to, once those get violated, take price back down to this data low, which has a very high accurate way of hitting. Okay. Now let's say we go up here. Okay. Let's say, by the way, I don't like this because this is a little small. You're probably going to ask me why isn't this good, but it's too small for my liking. And I like to trade a little farther away. But here's the thing. What if this was like fully closed, and what if price just went down here at this time? Okay. If price doesn't form any bullish fair value gaps here or any PD arrays, how are we supposed to take this back down to these data lows, right? We can't. So in order to actually entry, like the entry criteria on the setup, it needs PD arrays, okay? It needs a fair value gap, it needs an order block. So on the way up, when we're trading the opposite way from the data low or high, it needs a PD array. So if I just play price, first PD array that we get that looks good is this, right? The reason why it's good is because it's a singular fair value gap. You can see it's also in discount. So to me, this looks good. This one probably wouldn't draw. Okay. I think this one would be the better one, because this is obviously the more textbook one. This is just kind of small, just not mean anything a lot to me. This one, I actually would say this does mean something to me because it is an inverse as well, and it is a BPR. So this one I would draw. Okay. See that? And then This one looks pretty textbook. It's a singular fair value gap again. And then you can see right here, it's violated. Okay, and when that first one is violated, okay, it goes along in the inversion model, but you play candle, okay, you short wherever the inverse is, and your first target is always the internal liquidity. So your first target's always here. And once you hit that first target, stop always goes to break even. That's just how you trade the inverse model, and this is how you trade it. So basically, what you want to see here now that we've traded way away from this is you want to see a change in order flow. You want to see these fair value gaps start to be disrespected. So I drag these to the left. And once those get disrespected, there's a very high degree of accuracy we go back down to this low. So that's what you want to see. Okay. Now, for this situation, you can see we retrace back to the inverse. Okay. So you short this. Your first target would be this low. So I'm scaling some there. Okay. And then now for the next one, you put your buy limit down here and you put your stop to break even. So let's just play it a few candles. So we can see it would have been stopped and break even at that candle. So we would stop the break even. Now, that's okay because we can still re-enter. So again, I'm just going to look for another bullish fair value gap. Okay. Don't get one there. I mean, we technically do right there, but it's kind of small. So I would more likely use this one because this one, I like how this one, it shows that we respected it to the upside. So I would think we would respect it to the downside. It's just kind of a little more confirmation. All right. Now, this candle doesn't close under. This one does close under barely. So this would be your short. You see, okay, now this is getting violated. You short there. Okay. And then you just play the candles. Stop goes to break even when we hit the next internal target, which maybe it's here for you. Maybe it's here for you. Okay. And then you hold the rest till those data high or the lows, and then you sell. So this is the model. All you want to see is you want to see a wick or big abnormal wick traded at 8:30 on the news or 2 p.m. It doesn't matter. You want to see us put in a bunch of bullish fair value gaps, and you short once those textbook, which they have to be singular fair value gap, once these are violated. If there's multiple fair value gaps in the same leg, try to go to the higher time frame, use that one instead. But you can see this one, this wasn't a loss, it was just a win and then a break even trade. And then we got another entry to when we violated this. Okay, now we think we're going to go to these lows. Typically, I wouldn't short this. Okay, I would not short this candle because this is kind of far away from me. I would have liked this one. If this failed, I just wouldn't have. There would have been no reason for me to short this at all. But because these data lows are sitting down here, that gives me a little more reason to short because these are just targeted a lot, and we get a lot of market maker curves with these. Okay, and if you don't know what market maker model is, make sure you watch Zeusy's video on YouTube. It's just ZUESSY MMXM advanced lecture. It's like an hour video. But typically I don't short this out of the blue. The only reason I would have in this scenario is because we have the data lows below. So as soon as you see this bullish fair value gap, this triggers the model. And as soon as that is broken, we usually go down to those data lows. So that's what you're looking for. Sometimes you might get stopped to break even, which is okay, but there's always a chance to re-enter. And let's say you're just not paying attention. You could have even chased this right here. You can see we just closed under this with speed and displacement, and we just speed right to those data lows. So that could have been like another chase entry. You would probably went like small size in that one because the risk reward wasn't as good. But again, you can use this entry model with inversions. You can use it with order blocks. You can use it with breakers. I find it best with inversions, like I said, but it's up to you. And again, really good entry model and really highly accurate because these data lows and data highs are hit a lot. And my friend back tested it. He basically said besides one day in the last 5 months, out of every single data high or low made, there's only one day where they weren't hitting the same day. So basically what he's saying is there's only one day where we left like an abnormal wick and never hit it that same day. So they're usually always hitting the same day. So again, really high accurate model. This would definitely be my one setup for life if I had one, even though it doesn't happen a lot because it's just so good, and you can combine a lot of stuff with it. So again, that's my video on data highs and data lows. Let me know if you have any questions. And other than that, peace out.